Our next presenter is Hugh Rockoff.
Thank you very much. I'm afraid that you're going to hear a lot of the same things from me that you heard from Dick. We're very much on the same page. I would say maybe that I have a little bit more negative view of American banking history because we've been a very crisis-prone banking system. Because of the fragmentation of our banking system that we've gradually overcome, and I like to think of it as sort of three kinds of fragmentation: geographical, this problem of the state banking systems; institutional, that we have and have always had this wide range of non-bank financial intermediaries, and then the regulatory fragmentation that Dick also talked about. So first of all, where did this geographical fragmentation of the American system come from? A lot of it was really the product of the North-South divide in the U.S. It was always the South that was adamant that it did not want a banking system that was controlled from New York or Washington or somewhere. And it goes back to the very fundamental issue of race, really, in the United States. That was a big part of it. Dick mentioned the failure to recharter the second bank of the United States. Well, it was the southern states that voted against it, and then when it finally passed, it was a southern president that vetoed it. We've also had localism has been an issue in the U.S. So in a state like Illinois, at one time we had unit banking, and if you had a bank in Chicago, they couldn't put a branch in Peoria, and that was a little different. That wasn't the North-South divide. That was this desire for local control of banking. And as Dick mentioned, we then had, during the Civil War, there was an attempt to partially address the geographical fragmentation in the National Banking Act. But the Banking Act itself there was a lot of deference to the state government, so the national banks couldn't branch across state lines. So even though we had a better system, a system that was chartered in Washington, the geographical fragmentation persisted. And I also say we got the National Banking Act in part because the Southerners were out of the government, and so Yankee interests could for a consolidated banking system could prevail. I shouldn't digress because I have only a few minutes here anyway, but it did occur to me, we were talking about the idea of breaking up the monetary union in Europe between a North and a South, and you do get that in the American Civil War, that California stays on gold. They stay on the gold standard all the way till 1879, and in the East we have the soft money, the greenback. So we really had one country with two monetary units for an extended period of time. So Dick mentioned the fact that then we got these correspondent relationships going, and that kind of strengthened the system and allowed some capital to move into different regions of the country. But it's well known to American banking historians that this was also a great weakness, because then during these great financial crises, the reserves would be pulled out of New York, and we would get a complete breakdown of the banking system. So this is a story of 1890 and 1893 and 1907 and so on. So it was the system of pyramiding reserves did integrate the system up to an extent, but it still left us very weak. And so I think part of the lesson there is that, of course, you need, and I think the Europeans recognize this, some kind of centralized system for chartering banks and allowing this these separate state systems is a very weak system. So that's the problem of geographical fragmentation. Let me just talk a little bit about the institutional fragmentation in American banking. So, and Dick points this out, I think, also that as a result of this very weak banking system, we then developed various non-bank financial intermediaries to kind of fill in the gaps. And they did. The investment banks helped to move capital from the stock market into growing industry, and we had commercial paper brokers, and we had mortgage companies and so on that filled in the cracks and helped to integrate the system. But these guys also were a big source of trouble during these financial crises. If you make a list of all of the American financial crises, all the way through 2008 and going back to 1837 or earlier, they almost all started with a failure or a cluster of failures of these non-bank financial intermediaries. It was, I don't think there was a single crisis that started with a large New York national bank, right? It was always a group of lightly regulated or unregulated banks that got this thing started. So the U.S. has had this crisis-prone system, and we can't really claim, I think, that we've completely cured the problem as yet. Let me go on to the next slide there. All right, so we have all this fragmentation, and we also have then, as a result of that, regulatory fragmentation, right? So we have state banking authorities, we have the comptroller of the currency that regulates the national banks, we have the Federal Deposit Insurance Corporation, we have the Securities and Exchange Commission that regulates the investment banks. And this is a problem then because you have a kind of race to the bottom. Each regulator wants to have as much control over institutions as it can. And if these institutions can migrate from one regulator to another, they can play them off against each other. So, you do need, I think, and I think everybody kind of agrees on this, and you need some kind of Supreme Court or overall regulator who can kind of make the final decision. And of course, even the Supreme Court makes bad decisions, and over some kind of overarching regulator is going to make bad decisions too. Maybe we kind of saw that in Britain, during the run up to 2008. But I think it just doesn't make sense to have all these competing regulators and then different institutions kind of jockeying to find the best deal. So I think the idea of kind of centralizing chartering, centralizing to some degree regulation, I think those are pretty well accepted ideas nowadays. I wanted to say a little bit more about what the central bank should do, the lender of last resort, because here I kind of disagree with a lot of the things that I'm seeing nowadays and the experts are saying. So the first point is, and I guess this is kind of run through my talk, is that these financial panics and crises, there's just a tremendous social cost to them. I think Dick kind of made this point too implicitly, that we might not like cartels, we might not like regulation, we might prefer localism in banks and so on, but we're kind of willing to sacrifice all those things if we can avoid financial crises. And the idea that kind of bothers me a little bit is this idea that the central bank can determine in advance that there are systemically important banks, and they're too big to fail, and they have to be subject to specialized regulation and extra attention. And then there are other institutions that we can kind of decide in advance, we'll just kind of let them go. And the problem with that is, at least from the point of view of American banking history, is you just don't know where these things are going to start and how people are going to react to them. And you might have a large institution that fails and people were kind of expecting it and it has no effect. And it could be a private bank in Ohio and suddenly you see a contagion of fear growing. So I think, unfortunately, that the rule for the central bank really has to be to try to bail out any institution where they think there's a danger of contagion growing out of the failure. And I have an expression I use sometimes, too many to fail, right? So in the 1930s, for example, the problem was often not that some big systemically important bank was failing, but it was all these little banks out in Minnesota, local banks, failing. And the Federal Reserve decided not to bail them out because they weren't systemically important. But it was really too many to fail. So the analogy that I want to end up with here, and now I realize that in California maybe it's not such a good analogy. But let's say in New Jersey, in a city, the fire department has to follow a policy pretty much of putting out all the fires, because you just don't know when this fire that might be in some old worthless warehouse is going to spread to the rest of the city. So I think the model, and I have to admit I don't have everything worked out, but I think the central bank has to be kind of like the fire department, and then you have other mechanisms to come in and try to solve the problem of moral hazard by imposing costs on administrators of banks or on shareholders and so on. Just to kind of conclude, yes, the U.S. has developed a good banking system, and we've gradually overcome a lot of this fragmentation. But as 2008 shows, we still have a long way to go. So I don't think we're the model for maybe we're the model for what Europe should not do, and rather than what it should do.
Thank you very much.